let's get straight into it. And I would like to start with a bit of market overview. And Marcus, I would like to start with you. Just give us a general overview. Where do you think the market is right now? Where is there any risk? Where's the opportunity? And what's been happening overly on the market?
Well, the market at the moment is fairly fully priced, so it's not obvious where there is actually any cheap sectors or pockets of value. So, given that, it's probably best to continue to have a diversified portfolio. Now, what we've seen in recent times is volatility has been increasing, but it must be stressed this is off a very low base. Now, this is probably a combination because there is a lack of value out there, and also obviously some geopolitics in various parts of the world. So overall, the market looks pretty fully priced and was faced with pretty pedestrian growth, both here and abroad. And then that leads us on to other kind of like Chinese policies, and which is also reigning in, impacting credit growth overseas, in China, which is then flowing through back here to Australia in terms of lower commodity prices.
Okay, so in commodity prices, what exactly are you saying, and what do you see?
Well, because of the Chinese policies that are trying to rein in the credit growth, and particularly that shadow banking system over there, as well as trying to control house price inflation in China, there is expected to be a slowdown in construction, which of course comes back and impacts Australia, basically because of the demand for steel and iron ore and coking coal. And obviously we're starting to see that in terms of the commodity prices. And then on top of that, we've obviously had a global build in oil inventories. And so we're also starting to see the oil price come under a lot of pressure as well. So even though the market, there's no obvious areas of value out there, given the pressure on commodity prices, you'd have to think that our major resources might be an area of interest.
Okay. Now, Marcus, has the government had any play in the way the market has gone at all?
Okay, so coming back to the Australian context, yeah, look, there's been some policy initiatives from the Australian government, particularly the recent bank tax levy, but, in reality, this is more noise, than a strong headwind to profits for the banks.
What's happening with that government and banks levy? What does it mean for investors? And what do you think is going to be the impact on the price?
Well, as most will know, that the levy is about 6 basis points on kind of the wholesale funding sources, excluding the Tier 1 instruments, so impacting the 4 majors and Macquarie Bank. Now, the after-tax impact is circa only going to be about 3%, but that's before any initiatives that the banks may take. We're talking about the bank's interest margin here, and there's many levers that can be pulled. So I would expect that the banks, the major banks, will probably increase the investor housing rates or the smaller business lending indicator rates, and even kind of reduce the term deposit rates. So there's quite a pie there that the banks can kind of like manipulate the pricing. Now, it should be stressed that the other banks, both small like Bendigo and Bank of Queensland and the foreign banks, are not going to be price makers in these segments of, investor housing, small business or medium business, or even the retail term deposit. So because they're not price makers, they're basically going to follow the lead of our 4 major banks. And in fact, you could probably even see an enhanced kind of profit margin there for kind of Bendigo and BOC, the margin. So after the banks have kind of managed their interest margin, I would expect that the after-tax impact will be closer to, I would guess closer to 1% rather than the headline 3% that's been flagged. The bigger issue with the bank tax levy is that it's probably that because it's not capped, it's 6 basis points now, but it's not actually capped, and there's no sunset clause. So this could be viewed as a thin edge of the wedge. So the question is, what will this levy be in 5 or 10 years' time? Now, in 5 or 10 years' time, too, you'd imagine that the bad debt cycle would be closer to normal, so we'd have a higher bad debt charge being faced by the banks, also at a time when this levy might go up. The other thing to be aware of, this levy was introduced by a coalition government. which has traditionally been pretty business friendly. So imagine what it's going to be like if there's a Labor government in office, in the next election. It's obviously the banks are a soft target. It's politically expedient, and by soft target I mean that it's quite a popular kind of tax within the electorate. Now, the positives of this bank tax levy is that the Australian government guarantee, it's making the Australian government guarantee a bit more explicit rather than implied. So post the GFC, the government was always very cautious to say that they will support the Australian banks, but it was a bit vague. They wouldn't actually explicitly say they would guarantee the deposits going forward. But now that the government is charging for this support, you could actually say that this is actually an explicit government support going forward. So this is very valuable to the banks, particularly in times of a liquidity crisis. And so they will remain open for business if there were to be another GFC or if there were to be a run on the banks for whatever reason. And this is not just good for the banks, but this is also good for the Australian economy as a whole. It keeps the economy moving.
Yeah, look, I just wanted to bring it down. So what is there's a lot of different views, and obviously the banks have not come out right up front. Where do you gentlemen think that the levy is going to be coming from? Do you think the banks are going to take it out of their profit, or are they just going to pass it on levies and fees and so on?
I was going to say that the banks are just going to pass this on through basically higher product pricing, but it's not going to be in owner-occupied housing. That's going to be politically too hot. I think if anything, within the housing segment, it could be an investor housing. And also small to medium business lending. There's so many different kind of lending rates out there for different types of businesses. It's quite easy to kind of push through a kind of a price increase based on the indicator, on the benchmark rates that they publish. And also, they can manipulate the pricing on the deposit, the funding side of the balance sheet. So term deposit rates could be, maybe kind of reined in a little bit. And like I said before, I don't think they have to worry too much from a competitive response because their small bank competitors, Bendigo and Bank of Queensland, are not price makers. They will literally follow the major banks. So, if anything, that could actually help their profit margins around the fringe.
Yeah, absolutely.
Peter?
Yeah, I agree with that, Marcus. And I think the point to make is that I've been covering watching the banks now for over 2 decades. In fact, Marcus and I were a team with a top tier broker in the 90s. And the one thing that I've identified with the banks is that they're money making machines. They're continuously reinventing themselves. They've been able to extract efficiency gains through the implementation of technology over the last 2 decades. That's seen their cost to income ratios go from sort of the mid-70s down into the 40s. They've been able to introduce new fees and product pricing. So there's no concern from my perspective. I think they will be passing it on, and they'll be astute in targeting where they pass it on where they can. So I still am comfortable with holding the banks for the foreseeable future.
It's interesting you say that because almost every investor has 1 or 2, if not 3 banks in their portfolio.
Correct.
So given that the government has never really touched the banks and APRA sort of like let them go off a little bit, now that this levy has been introduced, what do you think is the outlook?
After the management teams kind of do some cost recovery through changing the rates on offer for deposits and obviously the lending rate. As I said before, I think the net profit impact might be circa 1% decline. So I don't really see this bank tax levy really impacting the outlook for banks. I think the bigger issue that's kind of been talked about in the markets the last few weeks on the back of this levy is that just it's some of the bears on banks have been louder out there talking about the normalisation of the bad debt charge. Look, this is a significant issue. The bad debt charges that the banks are experiencing at the moment are way below cycle averages. So as the bad debt charge were to normalise going forward through the economic cycle, the bank's profits will be impacted. But we need to stress that normalisation of the bad debt charge is quite a few years away yet. I would expect the bad debt charges to remain at these pretty lowish levels certainly for the next year or 2 years. The key thing to watch here is what's happening with unemployment and obviously cash rates, interest rates. But as you know, the Australian economy, it looks pretty pedestrian, but we've got, pretty close to full employment, or unemployment's 5.5%. People should be able to service their loans, and as long as unemployment remains pretty kind of anemic, like I said, these bad debt charges should be fine, and the bank's profits will be good going forward. Mm. Interest rates is the other thing to focus on, but the Reserve Bank's only going to raise rates when there's inflation were to accelerate, or growth in the economy needs to be reined in. Now, if that happens, obviously you'd expect that salaries, household income would also be growing, and the households would be able to service a higher interest rate. So it really comes back to, yes, the bad debt charge will normalise in the years going forward, but do not expect it to ramp up in the next year or even 2 years. But you just have to watch the unemployment rate.
Yeah, absolutely. I agree with all that. In fact, the two key drivers of bad debts is unemployment and interest rates. And to the extent that unemployment looks good, if anything, the labour market is actually tightening. One of the issues that we've had over the last few years is the fact that there's been a decline in wages growth, both here and abroad in the UK and Europe, and that's meant that free cash flow for households has been eroded over that time. So as you get an increase in, let's say, petrol or fuel prices, or as electricity prices go up, then it actually does put a strain on household budgets. But there's nothing in the outlook over the next 12 to 24 months that would suggest that there would be a significant increase in the bad debt outlook for the Australian banks. So that sort of brings me around to this whole discussion we're having at the moment about the housing cycle and the downgrade by Moody's, I think yesterday or the day before. Now, if we stand back and we look at the Australian banks, what's this all about? The IMF produced some figures recently that showed that the proportion of residential loan concentration on the Australian banks is somewhere between 60 or 65%. I can't remember the number exactly, but it's in that order of magnitude. If we jump across to the United States, the proportion of residential lending on bank loan portfolios is about 30%. And if we move across to the UK, it falls to even lower levels of 20% of residential lending on loan books. So there's concern in Australia that we've got a high concentration of residential loans. Given the performance of the Australian residential property market, over the last decade, over the last 24 and 12 months, there's concern about the market peaking. But again, I can't see an environment where you're going to get a 10 or 20% decline in property prices over the next 12 or 24 months. At best, in my personal opinion, you'll see property prices plateau. The other thing that we need to take into account is if we look at the average LVR of the Australian bank's loan portfolio, and by LVR I mean loan to value ratio, I think the average across the books is somewhere in the order of 40 to 50%. Okay, so the banks, from a portfolio perspective, have got significant equity in residential property prices. So I stand back and I listen to the governments talking down property. I listen to the regulators talking, property. I hear the ratings agencies come out with concerns about, the over-concentration of, residential lending on the Aussie banks' balance sheets. And I think, yes, no question, there's a risk, all right? But there's no systemic risk. There's no imminent collapse. So from that perspective, I remain comfortable with holding the Aussie banks. The other thing that we need to point out, and not many people are discussing, is that Australian households are actually 2.5 years ahead in their mortgage repayments. So there's no imminent threat of a collapse or a deterioration in property prices. As I said, average LVRs are good. Households are ahead of their of their repayments. Yes, household budgets may be tight, but it could be, lending, recent lending over the last 12 or 24 months, and that's not going to be half of their portfolio. So the risks are rising, but it's not Armageddon. The other important point that I'd like to make is the way that you and I manage our investments, our equity portfolios, are very different to the way that institutional fund managers invest. Institutional fund managers try and outperform the benchmark, an index. And it's significant to them if the index is up by 2%, if they're at 2.1%, that's significant for them, because it actually means that they'll get funds flowing from financial planners or advisors. Whereas for you and I, who invest, and we're long-term investors, we're not traders. We buy stocks on a buy and hold basis to create wealth over a period of time. When I bought ANZ at $4 and Westpac at $2.40 and NAB at 10 or at 17 or at 18, and now the stocks are up at $30, $37, I'm not going to trigger a capital gains tax to save myself 5 or 10% underperformance. I'm prepared to weather that, unless I think there is a significant risk to my dividends, which will affect bank valuations, unless I think there is a significant deterioration in unemployment, or unless I believe that interest rates are going to rise sharply, which pose imminent threats to valuations. Because the thing about the institutional market, or the market in general, it's always forward-looking. And you do get peaks and troughs, you do get cycles, and the banks' PEs expand during the good times and contract during the bad times. And that's what institutions manage around, trying to get that little bit of outperformance to outperform the benchmark. But for you and I, owning the banks, we're better off owning bank shares and getting a fully franked dividend yield than we are having our money as savings in the banks. So I'm still comfortable. It's been 26 years since the last recession. There's no imminent threat of a recession going forward. While wage growth has been, limited over the last 5 years or so, it now appears to be basing out, and we do expect wages growth to be tightening as the labour market has tightened. I remain comfortable, with the outlook for the Australian banking sector.
Yeah, like you talk about employment's pretty tight, but there is another statistic out there about underemployment, how that's been increasing, So there is some spare capacity there in terms of the employment market. But just to emphasise a point that you said before about property prices plateauing, we all saw that, particularly say in the Sydney kind of market during the mining boom and leading into the GFC, that the Sydney property prices basically tracked sideways. And until wage growth started to kind of move up again, or when the RBA kind of lowered rates. So rather than seeing a kind of like property kind of being smashed, property prices being knocked down quite heavily, if anything, as you said, they just flatlined and basically got back on the trend growth curve again. So yeah, I don't think there's much issue with the back. It just comes back to employment. So what is happening is the household is highly leveraged, but people will continue to make payments on their homes. If anything, what's going to be impacted first is the discretionary kind of expenditure, so consumption. So it's going to be the retailers that will kind of feel the pinch before the banks.
And that's what we're seeing at the moment.
Yeah, and we've also got the retailers being impacted by another issue too, which is the trend to online. So the retailers are in kind of like quite a painful spot at the moment, but we'll talk a bit more about that a bit later, about the Amazon effect and that.
Marcus, there's another observation that I'd like to make. When the IMF puts up charts showing that the banks, the Australian banks' concentration of Australian home lending is 60% compared to 30% in the US and 20% in the UK. That's an interesting statistic. But the reality is that Australia has a population base of 24 million people. Our business isn't as deep. Our business base, I should say, isn't as deep. It doesn't have the breadth that you do in the United States or in the United Kingdom or Europe. So the question I've got, is what are the banks supposed to do?
Yeah, and just on that, like, it's worth highlighting the difference between the US and Australia. So in the US, you've got the Freddie and the Fannies and stuff that basically house do a lot of the mortgage, heavy lifting in mortgages, whereas, as you said, the Australian banks basically do that heavy lifting for the Australian economy.
And that's right, they're securitized in those markets.
Yeah. And then the other big thing is here in Australia is that bankruptcy laws are so much stronger, tighter. So in the US, do you remember back during the GFC, people were referring to jingle mail? It's basically if you didn't want to stay in your house anymore, didn't want to service the loan, you basically put the keys in the envelope and send it back to the bank.
To the bank, yeah.
So the Australian kind of the legal structure is a lot tighter. So you could be very careful when you see some offshore commentator, hedge fund or whatever, talking about shorting the Australian banks because of their heavy exposure to an overpriced property sector.
That's good. Hey, gentlemen, speaking of housing, I just want us to move on to the next issue that I wanted us to talk about. So we've spoken about the banks. You guys are fairly confident the banks will do okay. But what else is trending? Because we can't all be waiting all our investment on the banks. What else is trending? Which other sectors or themes should we be looking out for in financial year 2018?
Well, yeah, okay, I've got a few things to say there. As our audience will know, that one of the key things about markets is that markets tend to overreact, and it's just basically being ready to kind of act when you see a situation. So they create these opportunities. So at the moment, on the one hand, the market, it's not obvious where the value is out there to what to buy, but we start coming back to these softer commodity prices, and particularly oil in the last couple of days. That's been particularly hit hard as the inventory builds in the oil, for example. I would think that the area that everyone should be looking at would be in those large miners, particularly in the Rios, BHPs, maybe Oil Search, even Santos, probably a bit riskier than Oil Search. But just coming back to Rio and BHP,
can you focus a bit more on that, Marcus? Because that area in the last 2-3 years has been a red hot stay away from sector, and you're saying that's going to pick up, are you?
No, I don't think that we're going to see any strength in commodity prices. I just think that BHP and Rio are significant in terms of their scale. They sit very well on the cost curve. So what that means is that as the prices of their commodities decline, they will be kind of generating free cash flow at lower prices than, say, a lot of their peers. So yes, free cash flow will be impacted as commodity prices are reduced or come down, but BHP and Rio, particularly Rio, will be generating good free cash flow, and it should be stressed that they're basically the capex when they expanded rapidly to take advantage of the high commodity prices. A lot of that's basically done. So the balance sheets are looking very good. The capex is reduced, and the free cash flow is still going to be very significant. So and shareholders should benefit from a combination of dividends, but also buybacks. So if the share prices were to get knocked around too much, the management teams will actually elect to do, EPS accretive buybacks because of it, funded by this, good cash flow and strong balance sheet.
So, given the quality of the balance sheets and stuff, and given the uncertainty around the commodity cycle, is it time to be buying quality stocks like BHP and Rio?
I think it's probably time to start nibbling at it. I wouldn't go in boots and all, but I'd probably kind of put a toe in the water and start buying some. But the trend is your friend, and you think that the commodity prices will probably keep dropping, but who knows where they're going to bottom out at. Moving on to oil for a sec. Look, I thought oil was probably getting close to bottoming too, but overnight it got down another 2%. So. It's very hard to pick the bottoms and pick the tops and things. Probably the best way to do is probably just averaging down, and as vice versa, when things pick up, you don't know when it's going to peak either. You don't drop, to be able to drop all your exposure on a stock on the peak of it's very difficult too. So you tend to let a bit out as the prices go up. Same with the prices going down now. Probably time to start nibbling.
Okay, and what about areas like innovation and agriculture? Do we see anything happening in those areas as well?
Yeah, in terms of the growth sector, the growth areas for the Australian economy, agriculture is a bright spot. It's very difficult for equity investors to gain exposure to this sector. Obviously, you can look at Elders and Ruralco and Australian Agricultural Company and so on. They've done quite well. Australian ag is doing very well because, one, you got commodity prices. Sorry, the Aussie dollar is a bit weaker versus during the commodity boom. And of course, finally, we've been talking about it for 10 years. Is basically demand for protein out of Asia. So why have commodity prices, all like cattle and et cetera, kind of decided to jump in the last 12 months, rather than 3 years ago? I can't answer that. Certainly, it looks like agriculture is doing well at the moment. Tourism is another area within the Australian economy that's doing well, and this again helps the east coast of Australia, which is large, and agriculture is largely east coast as well. Tourism's doing very well. You've seen the kind of the load factors for the planes, Sydney Airport, etc., all benefiting from the travel. And they're probably two of the areas that we see a lot of opportunity. And then of course you've got health. The aging population. Health continues to be a growth area, but the problem with these health stocks is they all seem to be fairly expensive, fully priced. But obviously you get stocks like ResMed and CSL went on, if they had their down days, they're the ones to kind of get that medium to longer term growth exposure as well.
All right. Well, look, Marcus, you've already mentioned a few stocks. I wanted us to get stock specific. Marcus, do you have anything else? Because you had called up Rio Tinto and BHP. Now, look, we spoke about the banks, and you guys were fairly confident with the banks. Which two or which out of the banks do you think will do better than others?
Okay, well, I think probably Westpac and NAB are probably. Look, I'm probably splitting hairs here in the four major banks, but probably I'd go Westpac and NAB. If you look at Westpac's performance, say in the last 12 months, it's underperformed its major peers. Westpac is very well managed. It's got a very good balance. It's well capitalised. I mean, all the four major banks are very well capitalised. In terms of global positioning there with the regulators. I think Westpac's finally kind of making the right decisions and inroads on its technology path going forward. Now, with regard to NAB, I think NAB's business mix, NAB has outperformed Westpac over the last year, but I think NAB's business mix is probably a bit, at the fringe, probably better going forward. But we talked about agriculture doing better. Well, NAB has something like 30% market share in ag in Australia. Again, small to medium business is where we would anticipate or certainly hope that the Australian economy does pick up. And again, NAB is the key bank for the small to medium business sector. And of course, barriers to entry are very high in the SME space too. So, in terms of foreign competition coming into the Australian market, if it were to come into the Australian market in any meaningful way, NAB is well positioned there as well. And of course, you've got the NAB is, has been very accident prone in the last 15 years, but they've cleaned up their business mix. Finally got rid of the UK, etc., the US, and so on. So NAB is probably on a upgrade path going forward. So, I think all four major banks, they're pretty similar, but I'd favour NAB and Westpac. Peter?
Yeah, I wouldn't disagree with that. I'd probably nudge Westpac a little bit ahead of NAB. I think that there's greater synergies to be extracted from those regional bank acquisitions of the last decade. I think that the brand presence in the regional markets is a bonus, and I think the underperformance of the bank against the sector over the last 12 months does make it a little bit more attractive. The only thing that I would say is that, as you touched upon, Marcus, is that NAB probably has a better diversified portfolio in terms of its business and residential mix, whereas Westpac probably has a high proportion of residential lending in its loan book, and that's probably why we've seen, the underperformance over the last 12 months. But either of those two, your quality stocks, quality management, no problems for me.
All right. Well, look, Marcus, you mentioned something about market overreaction. Now, if we're looking at the price chart, and I put these up intentionally, this is the 1st of May, which is round about the government announced the new bank levies. So you can see both banks here sort of like dropped quite drastically within the week of that announcement. Would you guys term that as overreaction, or is that just the trend with the general Aussie budget on a yearly basis?
Yeah, well, I'll go first on that. I think, as I said before, I think at the time when we're talking about the political risk with the major banks, and as you say, with this, you can see in these share price charts, there was also a increasing discussion about the outlook for banks with, a normalisation of bad debt charges. So I think it was a combination of the political risk, but also just people talking about dividends might get cut as bad debts rise. And what I've tried to stress earlier is that I don't think we're going to see bad debts rising in the very foreseeable future. Again, my caveat there is watch the unemployment rate, but I don't think unemployment is an issue in the short term. So therefore, I don't think bad debts charges are an issue for the bank. So yeah, I think that's, when you look at those charts there, Shepherd, I think, yeah, that's probably a buying opportunity. Bear in mind that, I said before, I think the Australian market is fully valued. And it's very hard to find value. I think, there's good and the dividends for the banks are pretty secure. I think that, these charts show that Westpac and NAB, and like I said, probably all four majors, probably not a bad place to be.
Okay. Well, look, I want to talk about the elephant in the room slightly. We've all heard about the plans and the Amazon effect. I know you gentlemen are not quite prepared for this one, but it's for me, it's sort of like the elephant in the room. What do you guys think? How far do you think Amazon is going to impact the retail sector? And do you guys see any opportunity in that sector because of this Amazon move, or is that done and dusted for the retail sector in Australia?
Yeah, okay, the Amazon effect. So yeah, obviously we've all heard, ad infinitum about what's going on offshore in the US, and obviously Amazon coming to Australia, and obviously Amazon buying Whole Foods in the US and even moving into the grocery business. But coming back to Australia, look, Amazon does sound like it's all set to go here in Australia. Look, at the end of the day, it will hurt all retail stocks. It's a large competitor. But I think perhaps within the Australian retail sector, I think perhaps Harvey Norman and JB Hi-Fi are relatively better placed. And I say that because both Harvey Norman and JB Hi-Fi tend to be distributors or sell kind of large, delicate, expensive items of furniture or electronics, and people tend to want to touch and buy these products in store, and certainly are concerned about delivery, getting damaged on delivery, and so on. We've seen in the US recently, and obviously Amazon is very well established there, that Best Buy, which I don't know if you guys out there, the audience is that familiar with Best Buy, but it's quite, when you have a look at them, it's even their marketing and their kind of branding all looks very similar to JB Hi-Fi. So Best Buy has done quite well over in the US. Its top line revenue line has only been growing. It's pretty pedestrian, 1% or so, but what we're seeing is a very strong growth in its online capability. And Best Buy, instead of looking at its kind of bricks and mortar retail distribution, its store network as an albatross, they're using that as the differentiator where people can go in and kind of touch the product and have a lot of confidence about after sales support. So I think JB Hi-Fi will probably, what they should be doing going forward is starting to ramp up their online sales capability. So, Best Buy's got something like 18% of its sales mix is now online. A year ago, Best Buy was only about 15%. So Best Buy's ramping that up to try and counter Amazon. Whereas back in here in Australia, JB Hi-Fi, I think 4% or something of their sales is online. So there's a lot of room for JB Hi-Fi to push into that online space to try and kind of combat Amazon. The other thing was JB Hi-Fi. JB Hi-Fi is a significant distributor, retailer of electronics and so on, and it have very strong relationships with the manufacturers. It actually is globally relevant. Sure, Amazon's a hell of a lot bigger, but at least JB Hi-Fi has got that minimum scale. So, markets overreact. When's Amazon actually going to impact the Australian retail environment? Is it a year, 2 to 3 years' time? It's going to come at some stage. But again, the market's kind of priced an impact, today. I think there's probably time to, again, start nibbling at JB Hi-Fi or Harvey Norman, and then just kind of watch the Amazon rollout. And again, Harvey Norman, obviously it's more furniture as well. Again, people want to kind of go and sit on a couch. They don't want to kind of look at a couch online and kind of like put the order in. So they're probably the two retailers I think are probably quite interesting.
I've got very little to add to that, other than saying that retailers have already been hit, whether it's because of slow sales or the Amazon effect or what have you. At the end of the day, it's a search and quest for value. I'm probably more interested in a question that we're getting from a gentleman called Neil, who's asking the question, Marcus, whether Apple and Google are a serious threat to the banks here in Australia and globally. I'll have a go at it first, and then I'll hand it over to you. I think the answer is there's no question that technology is creating disruption, not just in the banking sector, but across all industries. However, I think with something like banking, it can be broken down into deposits and lending and payment system, and I think that we're probably looking at a generational change, something that's going to take 20 or 25 years really for an Apple or Google to come in and be considered in the same light as a bank. The other thing is that banks have got huge budgets, and banks themselves are major investors in technology. And today and for the past decade, they've been scouring the world and looking at new technologies that have been coming up. And you won't be surprised to find out that banks actually own 20 or 25%, of new product providers or new fintechs that are developing. So I think that the sort of the Google and the Apple effect are something to keep note of, and that are interesting. But I don't think that we're going to see a significant impact to the bank's profitability by these players over the next 5 to 10 years. What are your thoughts, Marcus?
Yeah, I think that's right. And and obviously Apple and Google, their key area is going to be the payment transactions part of it, kind of the value offer, rather than the deposit side of things. So again, people want to put their money with an approved deposit intermediary, something that's regulated by APRA. And at the end of the day, particularly the retail banks, their key advantage has been able to raise funding cheaper than wholesale. So this is their ability to collect retail deposits. Then, I for one, and I think most of you out there will probably prefer to have your money deposited with, one of the Australian banks. So that's where they make their margin from. Yes, Google and Apple, etc., will impact the transaction volumes. But as you said, Peter, these banks are big. Our banks are very big banks, even relative to a lot of US banks. They have big technology budgets. Sure, they haven't spent it well in all cases in the last 10, 20 years, but they don't want to be at the cutting edge of technology. They want to be kind of fast followers in terms of banking services.
Mm. Right. Just another quick question off the banks back to resources, Marcus. You mentioned Rio and BHP. We've got Sharon here asking, what about S32? Is that poised to ride that same wave as well?
Yeah, I think so. I think we're talking about commodity prices in general, but I was focusing more on the steel stuff, hence the iron ore and the coking coal and stuff. But S32, it's got a different portfolio of commodities, but I would paint all commodities in a pretty similar broad brush at the moment. And obviously S32, again, like its big brother BHP and stuff, is very well positioned on its cost curve. When its global competitors are suffering as lower commodity prices, S32 is still going to generate better free cash flow at lower prices than a lot of its peers, which, yes, will impact the share price because there's a drop in free cash flow. But at the end of the day, S32's got a very good balance sheet and, can return that free cash flow in terms of dividends or buybacks. And doing buybacks at low share prices, we all know, improves the earnings per share and dividend per share for those shares still outstanding.
We've got another question from Edward here, and he says the mining service companies seem to have been rising of late. Do you gentlemen expect that to continue? Just give us a few examples there.
Yeah, I don't really have a particularly strong opinion, a view of the mining services. I think they've suffered in the last few years because obviously a lot of the capex was reined in, and obviously kind of like developing new deposits, etc. They kind of went on a bit of a capex holiday in terms of exploration holiday. Sorry. Yeah, I think that's probably hit flatline now, and so you basically, if anything, starting to see a bit more kind of the bigger miners starting to think about where the next growth in deposits going to be. That they tend to think long term. The miners, particularly the big ones. So some of those mining services are probably not badly placed.
Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. With so much information out there, how do you quickly sort through the companies worth investing in and those to steer clear of? Scaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Scaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Scaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Scaffold for a test drive today?